We're always told the stock market is this incredible place, a path for anyone to build serious wealth. But what if that's not the whole story? What if the game is actually rigged against you right from the very start? Today, we're going to pull back the curtain on the hidden forces, both out there in the market and, inside our own heads, that are causing millions of everyday people to lose their hard-earned money. So let's kick things off with a simple question. How does a small group of insiders illegally pocket over a crore of rupees? Now, this isn't some made-up movie plot. This is a real-world scheme, and it happens way more often than you might think. It even has a name: front-running. Okay, so what in the world is front-running? Well, imagine a broker gets a massive buy order from a big client. We're talking an order so huge they know it's going to push the stock's price up. Front-running is when that broker illegally uses that secret tip to buy the stock for themselves first. Then, just moments later, when the client's big order hits the market and the price jumps, they sell for a quick, guaranteed profit. It's basically the financial version of knowing the winning lottery numbers before the draw. Totally illegal. And the crazy part is how simple the scheme actually is. In a recent case that SEBI, the regulator, cracked, it played out in just 4 easy steps. First, you've got the tip-off. Dealers inside a firm get the secret details of a client's huge trade. Second, the leak. They immediately pass that info to their network of buddies. Third, the front run. That network jumps in and places their own trades just seconds before the big one goes through. And finally, the profit. As soon as that large order moves the price, they cash out for an instant, totally risk-free and completely illegal gain. So, did they get away with it? Not a chance. When SEBI brought the hammer down, it was severe. A total of 12 entities, we're talking dealers, their family members, anyone connected, were banned from the market for 5 years straight. But believe me, it didn't stop there. On top of getting kicked out of the market, the regulator slapped them with a pretty hefty fine, a combined penalty of 90 lakh rupees. And here's the real kicker. They were forced to disgorge, which is just a fancy word for payback, every single rupee they made illegally. And that amounted to a massive 1.07 crore plus interest. The message from the regulator couldn't have been clearer. Crime does not pay. But look, that's just one example of outright illegal fraud. It doesn't explain the much bigger and honestly more alarming picture. Why are millions of regular people, everyday retail traders like you and me, losing money in the markets every single day, even when nobody's breaking the law? Well, a recent report dropped a number that should honestly make you freeze. A staggering 93% of individual traders in India's futures and options market lose money. Just let that sink in for a second. 93%. If someone told you your parachute had a 93% chance of failing, would you jump out of the plane? Of course not. And yet, the number of people diving headfirst into this market is exploding. So what is really going on here? The answer, it turns out, is twofold. First, and this is the tough part, we have to look at the enemy within. See, the biggest opponent you'll ever face in the market isn't some slick Wall Street shark. It's the person staring back at you in the mirror. It's all about your own brain's hidden blind spots. A great way to think about trading is like a high-stakes poker game. In poker, you're not really playing the cards in your hand, are you? You're playing the other people at the table. You're reading their psychology. Well, trading is exactly the same. Sure, it's a game of numbers, but it's way more of a game against the market, against other traders, and, crucially, against your own mind. The first mental trap we all fall into is a classic. It's called the gambler's fallacy. This is that mistaken belief that past random events somehow influence what's going to happen next. It's that feeling you get at a casino when you see the roulette wheel land on red 5 times in a row, and you just know, you're convinced it's got to be black next. In trading, this sounds painfully familiar, doesn't it? We've all had this thought, man, this stock has been dropping all week. It has to bounce back tomorrow. But here's the thing, the market doesn't have a memory. It doesn't owe you anything. A stock can just as easily go down for a 6th day as it can go up. All right, next up is maybe the most dangerous trap of them all, the sunk cost fallacy. This is our totally irrational need to stick with something just because we've already invested in it, whether that's money, time, or just emotion. We absolutely hate admitting we were wrong and just taking the loss. And this leads to that really dangerous voice in your head that says, I'm already down so much on this, I can't possibly sell now. If I just buy a little more to average down, I'll make it all back when it finally turns around. This right here is exactly how a small, manageable loss snowballs into a catastrophic one. You're just doubling down on a mistake and digging the hole even deeper. And oh, the list just goes on and on. You've got survivorship bias, where you only see the one guy who got rich off a crazy strategy, not the thousands who went broke trying it. There's herding behavior, where you jump on a stock just because it's trending on Twitter. And then there's confirmation bias, where you only look for news that confirms you made a brilliant choice and you ignore all the red flags. Seriously, your brain is a minefield of these traps. But hey, even if you manage to become a master of your own psychology, you still have to deal with the enemy without. There are real sharks swimming in these waters, and in today's digital world, they're more sophisticated and harder to spot than ever before. Let's break down one of their favorite plays, the classic pump and dump. It starts when an influencer, one of these so-called finfluencers, secretly starts buying up a cheap, obscure stock. Then comes the pump. They hype it like crazy on social media with all kinds of false promises. This creates a massive wave of FOMO, fear of missing out, and retail investors rush in, causing the price to inflate. Then, right at the peak, the influencer quietly dumps all of their shares for a huge profit. And the scheme ends with the inevitable crash, as the price collapses, leaving all of their followers holding worthless bags. And believe me, this isn't just some theory. This exact scheme is what led SEBI to ban several people, including the famous Bollywood actor Arshad Warsi. The allegation was that they used YouTube channels to spread fake news, like a major company was about to buy a smaller one to pump up stock prices. The manipulators allegedly walked away with over 40 crore rupees in profits, while the retail investors who bought into the hype were left with devastating losses. Now, beyond the human scammers, there's an even bigger, almost invisible force you're up against: algorithms. In the US market, something like 75% of all trading is done by machines. In India, it's already about half. We're talking about high-frequency trading firms with supercomputers that can make thousands of trades in the blink of an eye. They're exploiting tiny price differences before that data even has a chance to show up on your screen. For a regular trader with a laptop, it's like showing up to a gunfight with a butter knife. So, with the odds stacked against you, both from the outside and from within, what can you possibly do? Well, the key is to stop playing their game. You have to start playing a completely different one. You've got to shift your entire mindset from being a gambler to being an investor. Nitin Kamath, who founded India's biggest stockbroker, Zerodha, he put it perfectly. He said, day trading is probably the toughest place on the planet to make easy money. And I love this part. He said the only thing that's actually easy about day trading is opening the account. And look, the cost isn't just what you see on your account statement. The constant stress, staring at a screen all day, the emotional roller coaster of wins and losses. It costs you your valuable time. It costs you your physical health. And it definitely costs you your peace of mind. These are the hidden costs that never show up on a ledger, but they are incredibly real. The alternative approach is probably best summed up by Warren Buffett. He famously said that he'd rather figure out what a business is worth first without even knowing its stock price. And that's the crucial insight, right? The price flickering up and down on your screen tells you almost nothing about the actual company, its health, its leadership, its future. So we'll end with this question for you to really think about. When you look at the market, what do you see? Do you see a casino, a place where you can get lucky with a quick bet? Or do you see a collection of actual businesses that you can study, understand, and partner with for the long haul? Because the answer to that question will determine which game you're actually playing.